Okay, so good morning, everyone. Welcome to the Macro Snapshot. We are Tuesday, May the 13th, 2025, recording this in the morning about 7:40. Okay, so the main thing we have today is the CPI. Interesting just to see, first of all, what those numbers are. So let's just have a look and see what the market is expecting here. So if we actually look at actually it's just a second, let's just see here. So what we're actually expecting here is the month over month to be 0.3, so significantly more than last time. And if we look at the month over month number, the core number excluding food and energy, also 0.3. So both the core and the headline month over month are expected to go up. So really the question is, this number is for the April period, and in theory that encompasses some effects from the tariffs. So really what the market wants to know is, are we seeing any kind of increases being reflected in this from the tariffs? And one way we could look at that is to actually, like Goldman Sachs, I just saw a note, they're looking particularly at sectors which are particularly sort of exposed, as they say here, to the Chinese sort of imports. And you're looking at things like maybe apparel. So you're looking at things like household appliances, clothing materials, and footwear. You're looking at things like, household furnishings. So, luggage, personal items, glassware. A lot of these kind of things here you see in the consumer prices, where they're expecting maybe extra, sort of quite a substantial hit, because a lot of this stuff comes proportionally from China. But the real question is, does the market care? And one could argue that since, so April, obviously we've had the tariffs, and we all know what's gone up and down with Trump. And we know that most recently, over the weekend, both sides, the Chinese and the Americans, agreed to reduce their tariffs on each other's products by 115 basis points. So the temperature has been lowered a lot. And the question really is this old data? So it will be interesting for a couple of things, as I say, just to see what's going on, especially in these sort of areas where there's a lot of Chinese imports. And secondly, also just to see the market reaction. Does the market want to continue with this risk on, which we saw basically from the Sunday open, or will the market actually listen to this? So just in terms of what's expected here as well, this also probably the main thing here is just to sort of figure out what's going on with the Fed. And what's kind of interesting here, I just want to go on the CME FedWatch tool. And you can just see that we all know that the market has repriced in a fairly hawkish way recently, and the question really is, does the CPI, will that feed into it? And just to give a sense of this, if we look at, let's just take a meeting here, for example, September. No one is really expecting the Fed to cut, sort of in June, but, potentially July, September, and December are all sort of on the table. And if we look at the moment, where we are at the moment is we're at 425 to 450. That's where we currently are. And so what you can see here is it's just interesting to see just how this has moved. So let's say, for example, sorry, let's go to the current one. So this is for September here, and you can see that what's currently the most probable in terms of the options is a cut down from 425 to 400. So just one cut. But then if we actually compare it, you can see that going back, well, let's say not so much a day, but let's say sort of 1 week or 1 month, you can see that the market has substantially sort of become a lot more hawkish. So you can see that 1 month ago there wasn't that much at all, only about 3.5% or 2.7% of sort of the options market or the futures positioning was expecting the rate to remain unchanged. So this represents unchanged, and so you can see here that like at the moment it's now about 20% expecting unchanged. And on the other hand, what we can see here is that the number of cuts, let's say 2 cuts down to 375, you can see that that's been reduced. So this is where we are currently. It's about 24% of the positioning is indicating 2 cuts, whereas if you go back a week or a month, that was up to 40 or even 50%. So you can see here, again, just as an example on the September meeting, that the market has significantly repriced in a hawkish way. And so the question is today is whether, the Fed, sort of cares, or the market thinks the Fed cares about that. So let's just have a look. And I'm just going to throw up here. Sorry, I've got a lot of stuff on the screen here. Yeah, so just see, again, just what the range of sort of forecasts here. So if we go on the core number X, excluding food and energy, we'll go on this one here. And we can see that the range here is anything, or the standard deviations at 0.8, but let's look at the high estimate of 0.6 down to 0. So the dispersion is relatively wide. We have about 60 basis points of dispersion. As you can see here, the average is about 0.27, rounded up to 0.3. So anything which is, let's say above 0.4 is 0.2. It quite possibly will get, a sort of a relatively quick market reaction. But really, the issue is how much will that sort of stick? And at the moment, it seems to be a fairly risk-on kind of environment. And we can look at a couple of sort of charts to have a look at that. First thing I want to have a look at here is just a volatility. We see that volatility has really where are you actually? Volatility has really kind of collapsed over the last, 2 or 3 sort of trading sessions here. So we look here at the VIX, we can see that we're now well below that sort of Trump tariff announcement, which I have to say surprised me. So really just falling down a lot yesterday. We're now below 20. We haven't been below 20 for, as you guys can see here, for quite a long time, going back to the pre sort of tariff announcement. So volatility is pretty low. And what that means is that if we just look at the pricing, let's say for the ES, let's look at a one-day straddle here. So what I'm going to do here is just to look on the ES futures. So you see here the June contract, and what you can see is that the implied volatility ranking from 0 to 100 over the last 52-week period, it's down all the way to 24. So that's come down a lot. And also, if we look at the percentile, which was like a week or two ago, was in like 98, 99, 97, is down to 71. So definitely here that's got a lot cheaper. And if we actually just here look at the 0 DTEs. So this is the ES contract here. We can see if we look at a straddle, we'll just throw on a straddle here. You can see that sort of an at the money straddle. So you see the delta here is 50 on the calls, and here on the puts is 50 as well. So let's just have a look at that here. It's going to cost you about it's about 42, so it's about, 43 points, so about 170 ticks or 43 points. So as you can see, that's 1% would be about 58 points. So that's only about 0.75%. So very low volatility. The market not expecting a huge move here at all. As I see, you see the straddles here only about 40 points, which is very, very low. I remember looking at straddles on 0 DTEs going back to the height of the volatility. Sometimes that was up to sort of like 80 or even 120. So a lot cheaper. And that's just reflected that everyone's starting to feel quite comfortable. Trump is in the Middle East as of today. He's already in Saudi Arabia. No doubt we're going to get some sort of, probably some semi-silly headlines, but nonetheless kind of positive headlines about trade deals, investments of the Saudis, and, maybe Boeing aircraft, this kind of thing. So quite a lot of positivity. If we look at this from a technical perspective here, what we can see here is that we're at a very, very key level. We've gone actually above all of the moving averages here, at least like the 20s, 50, 100, and 200. So well above those moving averages again after that nasty kind of sell-off. And the market at this point is trending higher. We have some significant resistance here. As you can see, a lot of horizontal resistance at 58.65. That's a very key point. But the thing is here, if we get today, let's say sort of a CPI which is in line, the market I think will absolutely sort of love that and continue high for a little bit. Even if we get, let's say, 1/10 higher, so maybe 0.4 for that core number, I think there's a good chance of the equities being bought on a dip. Maybe not so much for the bonds. I think the bonds going to be a little more sensitive. We can see that the front end of the curve has been under a lot of pressure over the last few days. Also the long end of the curve, because basically there's an idea here. What's starting to happen as well is that we're starting to get more information about the spending bill, and it's looking as though honestly the cuts to the sort of the budget are going to be relatively limited. Therefore, the possibility or even the probability of a much still a very high deficit is still on the cards. So suddenly, if you've got a sticky inflation, you've got deficit spending which is not going to particularly be cut. What that means is that the economy is probably going to be sort of stimulated in a certain sense, especially if the tariffs remain at a low level. And on the other, so that means that the long-term bonds are under pressure. So look at, let's say, German bonds are also sort of under pressure here. You see the Bund down, and if we go over to the US space, you can look at something like the ZB, which is the sort of the future for the 30-year. You can also see that the long end's are under pressure. Now, of course, because that assumes if the deficit doesn't come down, that issuance will remain high. Again, the other big counter argument to that, of course, is this whole idea that eventually even sort of reduced tariffs still represent a lot higher level of tariffs than we've had historically, and eventually that will feed into the economy and bring down the economy, bring down inflation, and et cetera, et cetera, and the economy will slow. We'll have to see. That's kind of maybe a longer term play, which may take. And now I think it's becoming a little asymmetrical that there could be a cascade of, semi-positive, news on sort of trade deals and things like, Trump now over in Saudi Arabia and Qatar announcing all kinds of business deals. There could be, sort of a steady drip of positivity, which may be sort of a tailwind for the equity market. Whereas this sort of structural slowdown in the US economy, this may be something which may take 2, 3, 4, 5 months to appear in the data, if indeed it does appear in the data. And that's just why the bonds at the moment, I think, are under a little bit of pressure. The front end also is under pressure, though we see a tiny bit of green today. And that's just because, as we've looked at quite a lot, the Fed, it doesn't seem to be in any particular hurry to cut at this point. And if we continue to get sticky inflation, we'll see later on today, sticky inflation and a relatively robust sort of economy and a strong labor market, the Fed, has the luxury of not particularly needing to do much. So let's see how we go today. Oil came off a little bit yesterday. Again, hit some resistance at the 50-day moving average, also 50% fib retracement. There's still plenty of oil in the world, so the oil market is taking a pause. But to be honest, it looks as though this was a double bottom retest, and oil, quite possibly if we get some positivity, may just want to retest these highs as well. In terms of the currency, is quite interesting. The dollar, just taking a little bit of a pause. And what we're seeing from a technical perspective is that a lot of the major kind of cross pairs are actually coming up against so the first signs of resistance. So it's almost like the easy work was done. There was a little bit of euphoria yesterday on these sort of lower than expected tariffs and the positive sentiment. But now, the structural issues potentially facing the US economy. Let's see what happens here. So we see that on the dollar index itself, it's coming up against sort of a downtrend, also hitting the 50-day moving average. And if we take this fib from the most recent impulse starting just before, late March here, we can see we have a sort of a 61.8 fib retracement. So the dollar there, the dollar index under a bit of pressure. And that's reflected if you look at quite a lot of the other sort of cross pairs here. So if you look at something like against the USD JPY, again, at the 100-day moving average here, well, isn't that actually the 200-day? I know, I think it's the 100-day moving average, starting to get up to that sort of horizontal resistance as well. So the US dollar facing pressure there, also against the euro, similar kind of situation here. The euro has fallen, but again at the 100-day, at the 50-day moving average, and at quite a key retracement point. If we just throw on a fib here, we can see that that's also at the 61.8% fib retracement here. So both against the dollar index itself, also against the euro and the JPY, just coming up against some technical resistance here. Something like the Aussie, which is risk on currency. Again, not finding it that easy, the Aussie to go up, just because the US dollar itself overall has had quite a lot of strength. Probably possibly waiting for a lot more sort of specifics on the trade deals to really break out. Other thing I'm keeping an eye out is actually on copper. So if we look at copper, which, historically, in theory at least, is a barometer for sort of global trade and sort of a general economic health, we see that copper yesterday had a little bit of a pop, but it was very short-lived. Now, we know that the US dollar has been quite strong, so that's normally not great for sort of base metals or indeed precious metals. But I was a little surprised, or at least interested, to note here that copper didn't really sort of participate in the euphoria and is still, quite just sort of sideways, trading in a sort of a sideways range here, and doesn't seem that convinced that everything is good news. And this morning we also had a couple of comments. I forget who was one of the Chinese vice premiers or something. Just the rhetoric was a little bit tougher, just saying, we have to, get a good deal for China and everything. So it's going to be quite interesting just to see over the next week or two when, the specifics of tariffs becomes a bit more difficult to actually come up with good news, whether that will start to grind away. Again, we might start seeing some weakness in the equities and the US dollar. Probably not today. But just we'll see how patient the market is to get the sort of specifics coming out of these trade deals. And keep in mind, there's still nothing announced with the European Union. So we'll see what happens. Just finally here, just to look at gold. Gold, has been under a bit of pressure here. Again, coming down to this sort of a little, I guess we can call it like a triple bottom here at about 32.10 on the futures. Let's see if that holds, or is this going to be sort of a double top? Personally, I'll be looking at gold maybe a little bit lower here, something like this 50-day moving average, which coincides here. You see this fib retracement of 61.8 at about 3180, 3200. That's a pretty interesting level. And for sure, there's still a lot of structural interest in gold. We know the Chinese retail sector is buying. We know central banks are buying. And as I say, maybe over the next week, when the market starts to understand that there's not going to be any, extraordinarily quick and specific resolution to the tariff issues, who knows, maybe gold will sort of regain its luster, so to speak. But maybe to see that we need just to see a little more negativity, and maybe we need to also see the US dollar weakening a little bit. Okay, guys, so I'm going to leave it there. That's about it. So mainly just looking at the CPI, as I say, looking to look at some of those some of those sectors which are very focused or very heavily influenced by Chinese imports. As I say, like household goods, apparel, clothing, footwear, this kind of stuff, to see what's going on there. Also interesting is going to be to see whether there's more downward pressure on things like discretionary sort of spending, things like sort of hotels and airfares and whatnot, because those prices had been trending down a little bit. So interesting to see, as I say, if they trend down. Okay, leave it there. Have a great day, and we shall continue the conversation. Thank you.